Good morning or happy midday to you. Thanks for tuning in to Saxo's Spotlight, where we look ahead for what you need to watch in markets this week, what you need to consider, and how potentially that may play into your trading and investing ideas. We're just waiting for Redmond to join us, but I would like to kick off by saying we've seen I guess a sharp reversal in sentiment. What actually happened was last week, we saw a very, very strong US jobs report that basically paves out a path for the Fed to potentially keep hiking rates. So last week, we, of course, had the Federal Reserve, the US Central Bank, basically saying that they can take their foot off the gas with interest rate hikes, and that sets a tone for essentially. An optimistic rally for equities for the long course. However, we've seen a lot of bumps come into play. We saw Apple, Amazon, and Alphabet, as well as Ford, all report weaker than expected results last week. And as a result, those big majors' shares tumbled. But Redmond has just joined us. So I'll just hand over to Redmond and then we'll touch on equities. Redmond, what are you seeing that's catching your eye and what should traders and investors be watching this week before I touch on equities?
Yes, yeah, I think it's the most important thing is really the really hot non-farm payroll we saw from Friday, and it's not only because the headline jumped more than 500,000, but actually all the monthly payroll number since July all the way through December last year was revised up on an average of over 50,000 a month. So it's and also on the household survey, the employment growth is in January is more than 800,000. That brought the unemployment rate down to 3.4. That's the lowest point, lowest unemployment rate since 1969. So that was a bit of a shock to the market, and that sent interest rate much higher, especially in the short end in the US, and 2 and 5 year yield jumped 18 basis points, while the 10-year moved by 13. And I think that is put some pressure on the stock market and on top of earning. But that I will leave it to you, Jessica, later on to talk about. So I think that the focus really is stronger labor market in the US that puts some concern on the current market expectation of rate cut in the second half of the year. That has pushed back a little bit, and traders has unwind some of those positions on expecting rate 50 basis point rate cut. Actually, it's before the number, the market pricing in 60 basis point rate cut in the second half, but now it moved it back down to 45. And so that is one of the key things. And the other thing also, that will also pushing up the dollar, and dollar actually up, except against the Canadian dollar, is up more than 1% against all the major G10 currency on Friday, and Australian dollar was one of the weakest one. And then is this morning we saw some weakness in yen, and mainly because in Nikkei there was a report saying that the Japanese government is actually in very close in the late stage of this discussion or decision to nominate the current deputy governor. One of them, because there are two in the BOJ, is Amamiya, Mr. Amamiya, to be the next BOJ governor. And noted, and Mr. Amamiya has been at the BOJ and working closely together with Mr. Kuroda since 2013. Especially in charge of monetary policy like the yield curve control, and so that is he is considered as one of the most dovish among the contender for the job, and so so that maybe he's more ties for the status quo. So that has been helping the dollar to rally against the yen and contribute to the yen weaknesses. And I pass it back to you, Jessica, on the stock market.
Thanks, Redmond. First of all, we've both mentioned the hotter than expected US jobs report. And with that being said, we do have several Fed speakers speaking this week. And I guess there is a risk now that we've had that hotter than expected US jobs report, there is a risk that some of these Fed speakers could actually, I guess, go against the grain and maybe even be a little bit more hawkish than the Fed was last week, especially on the back of that jobs report. So, with that being said, that potentially means that there could be more fuel to the fire for upside in the US dollar if we do hear hawkish comments from the Fed. What other things could we expect if we do receive hawkish Fed speaker commentary? Obviously, a high US dollar would also see US equities be pressured lower. So that's something to watch as well. Also, speaking about equities, we do have a bevy of electric vehicle and motor companies reporting this week. And what we would encourage investors to consider, we've seen some of the key components of the electric vehicle or of vehicles all in all, such as aluminium, copper. Um, we've seen some of their prices move to cycle highs. However, of course, over the last couple of days, they've trimmed some of those gains and they've headed lower. But all in all, off their lows, off the October lows, all of these key commodities prices are higher. And I guess this is one of the factors that contributed to Ford's weaker than expected result and outlook last week. Remember, Ford, their shares dropped 8% on the back of uh, I guess, a weaker than expected result that caught shareholders unawares. So that brings us to what we can expect this week and what you need to watch. Could a similar result happen with Volvo reporting, Toyota, and Honda as well? So we just urge you to consider that. Potentially, maybe that means using optionality to protect yourself against downside. Moving to the most sensitive FX couple of pairs that have responded to this very hot US jobs report. We've seen the Aussie dollar against the USD and the Aussie dollar against the euro essentially nosedive. However, now we've got the Reserve Bank of Australia, the central bank down here in Australia, meeting Tuesday. But we have to think that there could possibly be a knee jerk reaction to the upside for the Aussie dollar against the US and the Aussie dollar against the euro. Why? Well, we think that the RBA has been, I guess, somewhat dovish. Of course, it's only been hiking by 0.25% or 25 basis points, but the last three economic indicators have been hotter than expected. So that means we could potentially see a knee-jerk reaction rally up, but we do basically see the Aussie dollar, which is one of our favoured currencies for this year. We do see the Aussie dollar potentially losing some of its thunder because commodity prices are coming away. So just reiterating the weaker hotter than expected results that could stoke some hawkish commentary into the RBA decision tomorrow with a 0.25% hike. That's already tabled, but the commentary is what we're looking at. They might be telling us that building approvals they're going bananas. I mean, last week we saw building approvals in Australia make one of their highest jumps in a decade. So just extraordinary. Building approvals jumped 19%, recovering from a plummet. We also had a hotter than expected inflation report out from Australia today. And we also had stronger than expected retail sales. They were in negative territory, but they were hotter than expected. The bottom line is just keep an eye on that. And rounding it all out, we do think we have to pay attention to the long term outlook for the equity market. Now that the Fed has essentially somewhat been more dovish, we saw the S&P 500 mark a golden cross last week. And this is a technical event. What is a golden cross? It's where the 50-day moving average crosses above the 200-day moving average. Now, this is the first golden cross, a technical indication suggesting a bullish rally might be ahead. This is the first one that we've had in 2.5 years. So the undercurrent there is that markets do want to rally up, but we need more evidence. The Fed needs more evidence that they can take their foot off the gas. Now, I will just say this. If you look at the 52 times in history throughout since the 1930s, in fact, since the data was tracked, when we had a golden cross, the S&P 500 rallied in 71% of the occasions over the next year. So just consider that there is a long-term scenario at play that you might like to consider, that equities could rally over the year ahead, but they're probably going to be bumps. And vis-a-vis, we saw that with weaker than expected results from the tech majors last week, but we already touched on that. Redmond, back to you before we can touch on commodities, but anything else that you're watching or we think we should cover?
Yeah, I think just we'll talk a little bit about China and Hong Kong, and also Asia in general in terms of the equity market. And last week, Hang Seng was down 4.5%, and notably is the southbound money has been selling every day. So total net outflow from Hong Kong from the southbound money is $2.2 billion for the week, and then there's also some a bit weakness in Chinese market. And one thing and also is on Friday, it was actually the first time this is a daily net outflow from the Asian market through the Stock Connect, because it's a foreign money. I mean, it's through the Stock Connect. It's overseas money has been buying, has been leg buying in the China Asia market since January 3rd. And so very strong buying into Asia. And last Friday was the first time it has a daily let outflow. And having said that, for the whole, as I said, it's for the whole week, it's still more than $5 billion overseas inflow into Asia. So I think mainly, it's the market is still, I think it's the recovery in China is still going on. Or the data, I'm not going to go into the detail, but data coming out from China recently also showing as some recovery and strong, and also but because I think the market has gone up quite a bit, and so that is in a sort of ended in kind of a consolidation mood. One of the questions we have been asked from time to time by clients is whether they are too late or so on in participating. But one thing just want to consider, and most of the buying into Asia and Hong Kong, Chinese stock market, actually the allocation is really a hedge fund has been the short covering, also adding to exposure. And so according to some calculation, is about only 13. It is still below, underway, slightly below neutral, in terms of hedge fund. And then it's in global mutual fund, actually still quite low. I mean, it's according to some analyst calculation, is global fund allocation to China is only 8%. It's much below the average of in the past. So there's still a lot of catch up in terms of position wise to catch up, and because the peak is about 15% in allocation in China. I think that's something to consider. So maybe some pullback, maybe a time to accumulate some equities. And APAC is also seeing a lot inflow from overseas this month, and mainly China and Taiwan, and a little bit into Korea. And India is the market we're seeing quite a bit of net outflow in mutual fund. That's it for me.
I will just encourage everyone to have a look at our Saxo equity baskets, which are available under research stocks. And what's really interesting is this year we've seen, I guess, the most upside in bubble stocks. And that includes the likes of Facebook that reported stronger than expected results, and that $40 billion share buyback, which basically supports or underpins share price growth. But I will also say that we also have seen very strong performance in some energy storage companies. But I think when we step back and think about that diversification piece, we do see volatility picking up this week. So it could be worthwhile outside of equities looking at the VIX index and the US dollar. But if you think about equities more broadly, I think it might be remiss if we exclude those sectors and those baskets that we were talking about a lot in 2022, and they were defense and commodities. So even though commodity prices, particularly metal, I guess are taking a haircut, and perhaps some might say they were due for a haircut, but we do see commodities, particularly most metals, are heading higher for 2023, just underpinned by low supply and rising demand from China. But also defense. Remember, defense is also a cushion in your portfolio, particularly in falling markets. We saw a lot of defense names, cybersecurity holding up quite well. And if you think about year on year, who has performed the best? They've been defense and commodities. They're up. So defense stocks, if you have a look at our Saxo equity basket, it's up by 28%. And commodities have taken a haircut, but commodities are still up 18%. But for any questions, feedback, or comments, please reach out to your GST, and why not have a look at these Saxo equity baskets for inspiration. We wish you a wonderful week, and we'll see you again next week. From Redmond, Wong, and myself, Jessica Amir, and from Chiru Chanana, have a wonderful week ahead.